Thanks very much, Jeff. So I'm going to say about what went on in terms of mutual fund flows in both the equity taxable muni and money market side, and also touch upon what went on in the ETF sector as well. It was a pretty solid quarter for flows all around in terms of equity taxable muni. All three categories had pretty positive flows for the quarter throughout. On the equity side, both mutual funds and ETFs together took in about $50 billion. It was split pretty evenly between the two. It was certainly aided by the positive market backdrop that we saw in terms of returns. Not only was the domestic market up pretty solidly for the quarter, the S&P 500 was up 5.2, but also the international equity markets helped as well. EFA was up 4.3 for the quarter. So that was certainly a great tailwind for fund flows into the equity space. We'll get into a little bit more about where some of the sectors were favored and which sectors were not during the quarter within equities in just a moment. But taxable bonds also had taxable bond mutual funds also had a solid quarter. About $35 billion came in net into taxable bond mutual funds during the period. The Barclays Ag, that performance there certainly helped out as well with flows. The Ag was up 2% for the period. Now it's up almost 4% for the year, so certainly some solid performance there. There was $35 billion coming into taxable bonds. That's following Q1's solid performance of about $37 billion coming in. So quite a turnaround with taxable bond funds as 2013 closed out with 3 consecutive quarters of negative flows. I think there with the taxable bond fund flows turning positive, we'll see in a moment that core bond was the top segment gather, top classification gatherer for the quarter. Investors are a little less concerned now about the direction of long-term interest rates after the Fed has given a little bit more clarity on the winding down of their quantitative easing program. And also, it was viewed as a safe haven by many investors due to some of the geopolitical volatility that we saw earlier in the year. And additionally, the search for yield is back on. As we can see, money markets had quite a negative quarter with $60 billion flowing out for the period. Obviously, the yields there are close to zero on cash, and some investors really do need to put the money back to work, and taxable bond is one of the few places that they can go to get that. So looks like some of the money came off the sidelines this quarter to help that segment out. Munis also had another solid quarter. Certainly solid performance. The Munis Index, the Barclays Muni Broad Index, was up 2.59% for the year. It's up a pretty astonishing 6% for the year so far through June 30. About $5 billion came in there during the second quarter, about twice as much that came in during the first. And that's off of, once again, pretty poor performance last year in terms of flows. Last year was a record year for net outflows for the muni bond category. There, I think investors are being enticed back into the muni space, obviously for the yields. Really a lack of alternatives for a lot of higher net worth investors that are seeking yields is also helping to draw back in some investors to munis as well. And certainly the lack of any new fiscal surprises by municipalities such as the city of Detroit or and certainly Puerto Rico has been grabbing some headline news, but that story has sort of worked its way through the mutual fund space largely at this point. Moving ahead to slide 33, just talking about where some of the money went within the mutual fund space on the equity side. U.S. diversified equity, despite a pretty solid quarter in terms of performance, did see some net outflows for the period, about almost $4 billion coming out. Once again, we see investors really shunning growth, whether it be large cap growth, mid cap growth, small cap growth. Those categories we're seeing outflows during the period once again, but value was favored once again. Large cap value seeing some positive flows of about $3 billion. Multi cap value $2.5 billion positive. Some of the sectors that were favored the most within U.S. diversified equity were once again passive strategies. Those tied to, say, to the S&P 500 index. That segment, for example, saw $4.2 billion come in during the quarter, and also multi-cap core passive strategies and those with more of a diversified mandate also were pretty popular, with almost $8 billion coming in there. In terms of sectors, positive quarter there in terms of net flows, about $7 billion coming in. Some of the sectors that were favored the most within the equity space were those that were really equity income oriented. Energy MLPs were the leader, about $3.5 billion there. Investors really liking the sector. They have traditionally been a good income producer. Many of them are required, the underlying holdings, to pay out most of the income that they earn for tax purposes in the calendar year that they earn it. So certainly good income producers there with some solid energy asset bases underneath them that typically generate solid cash flow, which is in favor during this period amongst many investors who are a little cautious about equity valuations and the potential for earnings growth over the next coming quarters. Real estate funds had a solid quarter too. Once again, investors looking for that combination of income and asset-rich security. They saw about $2.8 billion come in during the period. Utilities, another solid taker of flows. On the flip side, in the sectors, as you can imagine, science and tech, biotech led the ways with outflows of about $1.5 billion apiece. There, obviously, there was some volatility at the beginning of the year, first, second quarter, on concerns about earnings, and had these some of the stocks gotten in those sectors, biotech, health, and science and technology, gotten too far ahead of themselves. Within world equity, that continues to do very well in terms of flows. About $18 billion came in last year. There's a lot of EFA-based passive strategies that are continuing to get the lion's share of the funds. International multi-cap core, for example, took in $8.4 billion for the quarter. Emerging markets are back in favor, again, with those seeking world equity exposure. The second leading category for the quarter, taking in $5.2 billion. International large cap core, certainly was on the plus side, and Europe continues to do well. Investors are really hoping that the European economy is just a few months behind us in terms of the economic cycle, so that stocks there might have some more room to run as they continue to emerge from their economic downturn. On the downside, a lot of growth. Once again, large cap growth was the leader out. So just like on the domestic side, investors are shunning growth, even on the world equity stage as well. Asia Pacific, China region funds, despite some pretty good performance later on in the quarter from the benchmarks, those funds continue to shed some assets. Just concerned about volatility and emerging in general, and some mixed economic signals coming out of China didn't help. So about $500 million coming out of China region funds, and about $200 million coming out of Pacific funds. Just skipping ahead to the next slide, slide 34, how some of the larger, more popular ETFs fared. Pretty similar to how the mutual fund fares overall, with a little bit more volatility, as you might expect. SPY, which is the large State Street S&P 500 product, had modest net inflows when all was said and done for the quarter. The EFA product, EFA, slight net outflows. Somewhat of a surprise, QQQ, which is the PowerShares NASDAQ tracking fund, the NASDAQ 100 tracking product, had net outflows of almost $3 billion for the quarter. The NASDAQ did rise 5% for the quarter, 4.98, but it was a somewhat volatile start, and it was down 2.6% in March and 2% in April. So I think the bulk of the net outflows came earlier on during the period. Emerging on the ETF side, certainly in favor as well. The iShares MSCI emerging product had a great quarter, took in $5.2 billion. Which was quite a reversal from the first quarter when $7 billion came out. The MSCI Emerging Market Index solid quarter. It certainly attracts this money, which tends to be a little more quicker to react to market movements than mutual funds, as we know. Was up 6.7% for the quarter. Had very solid performance in March and April as well, up about 3.5% during each of those months. GLD had the big gold ETF, had modest net outflows. DBY, which is a relatively small fund, the iShares Select Dividend ETF fund, positive flows. Investors there really after any equity-oriented income product that can generate yield for them. That certainly has attracted some attention. One interesting fund is there aren't many. I think there's only 5 bank loan ETFs. But BKLN, one of the larger ones, which is the Power Senior Loan ETF, that had net outflows of $327 million for the quarter. This is actually the first time that ETF, that particular one, had outflows since the third quarter of 2011. So almost 3 years really since we've seen outflows with that product. They are relatively small though. And once again, it's leveraged loan investors seem to be a little concerned about rich valuations and also the direction of short-term interest rates and where they might be going. Most likely up, and are there better alternatives out there for a lot of those investors that have gone in. But just moving ahead to slide 35, where some of the favored and not so favored classifications were within the mutual fund space during the quarter. As I touched on earlier, U.S. diversified equity, a lot of passive strategies there were the big winners. Large cap value had about $3 billion come in. So once again, sort of cautious investors who want to stay in the market are tending to favor value over growth. Typically, value stocks are income generators. Usually, some of them are beaten down companies with decent cash flow prospects. So there's a little more of a conservative theme, perhaps running through some investors' strategies when they are tending to favor value over growth. The sectors, touch on those a little bit. Real estate, energy, quite favored during the period. And on the world equity side, once again, a lot of passive strategies favored in terms of the international multi-cap core, and emerging markets is still a big favorite this period, as it was during a couple periods earlier last year amongst world equity investors. Losers, consistent theme here, large cap growth. Large cap core continues to see some outflows as well. Growth once again across the cap spectrum, mid, small, large, continues to see outflows as investors seem a little cautious about earnings prospects for some of these growth-oriented companies going forward. Touched on that. Some biotech, science and technology funds saw some significant outflows. And on the world equity side of the house, a lot of growth companies, growth-oriented funds, and those focused in Southeast Asia and the Pacific region saw some outflows as well. Moving ahead to the next slide, that's just showing overall what were the big gainers and losers for the quarter. Core bond, bit of a surprise, was the top gatherer of fund flow assets during the period, with almost $11 billion coming in. Once again, investors are embracing taxable fixed income after not doing so last year, as rates seem to have stabilized and people are rethinking what perhaps the new normal might be for long-term rates. Some of these other strategies, a lot of them are passive. Alternative credit focus, that's typically comprised mostly of unconstrained bond funds that go anywhere, fixed income products with sort of a multi-sector income mandate, those that can go anywhere in terms of asset allocation in search of the best relative value, but generally also in search of the best yield. So these are yield-oriented products that have become quite popular over the last year and a half. I've seen a lot of interest in them, particularly in this extended low-yield environment. Emerging markets, once again, one of the top gatherers of assets is investors seem to think that things may have stabilized and that there's some good opportunities there after some difficult performance last year in 2013. Some of the losers are cash money markets were obviously saw some significant outflows. Looks like a lot of that money went to work and taxable fixed income and perhaps munis. Loan funds, we touched upon that. Moving ahead to the following slide about taxable bond fund flows, just to look at all the 25 different classifications within the taxable bond fund sector. No surprise here, as we touched on earlier. The core bond came back in favor as investors seemed a little more accepting of where the fixed income rate environment might be over the next few quarters. But also the search for yield is still on in force. Some of the top asset gatherers within fixed income, those with traditionally higher yielding funds, saw the most in terms of net inflows. Those would be high yield, multi-sector income, alternative credit focus, as we touched on a moment ago. And emerging market debt, hard currency, has certainly seen a resurgence in flows as investors look for yield and perhaps a good buying opportunity there. In terms of outflows, loans is the big story this quarter in terms of outflows. Investors have seemed to think the valuations, valuations and concerns about short-term rates and better opportunities, maybe awaiting them elsewhere within fixed income. So an exit seems to have begun with some fund investors. There were 8 weeks, if you count last week, of consecutive net outflows within that asset class, and that's the first time that's happened in over 2 years. Ginnie Mae and short-term U.S. government funds continue to remain out of favor as investors seem to think that there were better yield opportunities and buying opportunities elsewhere within fixed income in general. The final slide, just trending classifications, touched on a lot of this already, but just over this month-by-month look this year in 2014 of how some asset classes have done in terms of flows. Real estate, which is in red, the flows have turned positive this year after a negative outflow in January and several months of negative outflows last year. Seems like a lot of equity income investors are interested in the asset class. Loan funds we touched on, seen some significant outflows in the last few months. And small cap growth, just an example of growth coming out of favor. And also small cap had a pretty volatile year so far. If you use the Russell 2000 as a proxy, we fell 3.88% in the month of April, which certainly did not help small cap growth in terms of net flows. But that's all I had. So at this point, I think I'll turn it over to Tom, and we'll probably open it up to questions.